Hi, this is Suzanne Long, and we're going to talk about the statement of cash flows. This is an introduction to the statement of cash flows. There'll be another video showing some practice problems of how to complete the statement of cash flows. Let's start with some background. Take a look at the four financial statements: income statement, statement of equity, balance sheet, statement of cash flows. Think about each one of those and what they mean and what they do, what they accomplish. Let's start with the income statement. The income statement includes revenue and expense accounts. Revenue and expense accounts, we've got add revenue, subtract expense, and we end up with net income or net loss. Net income then carries down to the statement of equity. So one of the things on the statement of equity is add net income. It's coming from the income statement. So everything that happened in the income statement, all of the effects of the revenue and expense accounts are boiled down and summarized into one number, net income or net loss. And that net income or net loss is a part of the statement of equity. All right, so think about the statement of equity. It could be statement of owner's equity, like, Bob Smith the plumber, statement of owner's equity, small business, or it could be statement of stockholders' equity. Common stock, preferred stock, paid-in capital, retained earnings, treasury stock. Think of the statement of equity. Think of the capital account, the retained earnings account. What happens in the statement of equity? We go from beginning to ending balance, and we're looking at anything that changes equity, like we issued stock, or we had net income, or we paid dividends. And we end up with ending equity account balances. And those carry down from the statement of equity to the balance sheet. So everything in the income statement ends up in net income. That flows into the statement of equity. The ending equity balances flow down and they show up in the balance sheet. So everything in the income statement and the statement of equity end up on the balance sheet. Okay, so balance sheet has all the effects from the income statement, statement of equity, and balance. So now moving from the balance sheet to the statement of cash flows, we've got the cash balance on the balance sheet. Ending cash on the balance sheet is ending cash on the statement of cash flows. So when we consider our four financial statements, they all fit together. Net income flows to the statement of equity, ending equity balances flow to the balance sheet, ending cash on the balance sheet equals ending cash on the statement of cash flows. So you could think of those financial statements as like a puzzle. All of those puzzle pieces all fit together, and they're all reflecting the changes of the business over time. They're all reporting out different things. Income statement reports profit. Equity reports changes in equity. Balance sheet reports final balances. Cash flow statement reports cash activity. So this is sort of the background on what's happening, how we end up with the statement of cash flows. The statement of cash flows represents everything, all of our transactions, no matter what account is affected. If something happened, what's the effect on cash? So we're going to look at, income statement folded into equity, folded into balance sheet. We're going to be focused on the balance sheet and taking what's on the balance sheet and converting it into a cash effect, either a positive or negative cash effect. That's what we're going to do, practically speaking, when we prepare a statement of cash flows. We're going to go from here to here, balance sheet to cash flow. All right, let's take a look at my outline down here. So this gold area on the left is the outline, and then the gray is a sample statement of cash flows. Let's look at the gray first. Let's look at the whole thing first in an overview sense. So I want you to check out the heading. Every financial statement will have a heading. 3 things: what's the name of the company, what's the name of the statement or schedule, and what's the date of this report that we're looking at. So always 3 things, always a heading. It's formal. It's a financial statement. Capital letters, nice presentation, as nice as you can get it to look, formal. 3 sections: O, I, F. And I'm going to add a little bit over here. Well, maybe I'll just stick with the gold. O, operating. I, investing. F, financing. I've been searching for years and years and years for an acronym. OIF. What could that stand for? The closest we got one day in class was Ohio is fun. And then everyone kind of groaned and said, well, we're Michigan people. Said, no, we can't go with that. So I would love an acronym for, a memorization tool for OIF. Just something to play around with. So first section, operating. So you're going to have all this stuff, you're going to add them up, you're going to get a number. Remember, this is the overview. Second section, investing, add them up, get a number. Third section, financing, add them up, get a number. Then you're going to add up those 3 sections. So you're going to add those 3 up, and that's really the total, this net increase or decrease in cash. That's the sum of those 3 sections. Cash beginning of the year, end of the year comes from the balance sheet. So this 3-line conclusion of the statement of cash flows really is given. You're going to have the balance sheet. You can plug in beginning cash, ending cash. You can calculate increase or decrease. I mean, you can start right here, and you can see what your answer will be. And then you've got to sweat out everything in the middle. Okay, so that's the overview. Let's look at the cash outline. What goes in the operating section? I don't want to see investing yet. What goes in the operating section? We're going to start with net income. We're going to add depreciation, add amortization back. If we've got a gain, we're going to do the opposite and subtract it. If we've got a loss, we're going to do the opposite and add it. Sorry. Current assets. We're going to look at every single current asset and see did it increase or decrease and what's the effect on cash. We're going to do the same thing with current liabilities. We're going to look at every current liability account. Did it increase or decrease? And what's the effect on cash? Okay, let's take a look at an operating section. So we start with net income. So this is like one line, net income. That's the whole income statement. Everything on the income statement, all of the effects of the income statement are summarized in that one line. And notice what we're doing, what we're saying. This is a statement of cash flows. So we're saying there's a positive effect on cash, positive number, of $653,607. So we're like starting with this assumption that all revenue will convert to cash and all expenses will be deductions from cash. Net income, positive number. So yep, that's where we start because for the most part that's true. Revenue will convert to cash. Expenses will convert to cash. Sometimes it's initially a cash transaction, just like we've seen, debit, rent expense, credit, cash. But sometimes it's like debit, utilities expense, credit, accounts payable. So it goes into accounts payable. Well, that's a current liability, so that would show up here. And eventually, that accounts payable for we got to pay it. So it is going to become, a credit to cash, a payment of cash. So we start with net income. We're assuming revenue and expense, all cash. And then we've got these adjustments. Adjustments to reconcile, blah, 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 blah. Depreciation is the first one. And you're always going to have depreciation. I can't think of any examples that we'll see where you won't have depreciation. Notice the outline leads with depreciation. Net income, depreciation, then amortization. You may or may not have amortization. Let's stick with depreciation for now. Depreciation, positive effect on cash. What? Okay, here's what's going on. Net income is income statement. So this number up here, we already subtracted depreciation expense to get to this amount of net income. So we subtracted depreciation here. We're adding depreciation here. So now it's like there's no depreciation effect on this cash flow statement, which is correct because when you have depreciation expense, you have no cash going on. Think of the journal entry to record depreciation. Can't type. Look at that journal entry. You know that journal entry. There's no cash. The decrease in value of a long-term asset does not affect cash. It affects expense. Yes, we're estimating. We're going to record some expense. And yes, we're estimating we're going to decrease the asset with this contra account, accumulated depreciation, but there's no cash. So by having depreciation included here, negative, subtract depreciation to get to net income, and then starting with the very first adjustment, depreciation add back. It's like we subtracted it here, we're adding it back here. It's like, whoop, it never happened. It does not have any effect on cash. So for the statement of cash flows, we want zero cash effect from depreciation. Okay, so that's what's going on there. If we had amortization, you would do the same thing with amortization. If we had amortization, it would look like this. We'd have amortization expense, and then we'd have something like credit patent. There isn't an account called accumulated amortization. The effect comes right against the intangible asset account like patent. There's just a little teeny bit of this in Principles of Accounting 1. There's more of this in Intermediate Accounting 1, and then there's more in the upper level bachelor's degree courses. So again, look at this amortization journal entry. No cash. Same idea as depreciation. No cash. So that's why amortization shows up. If we had it, we would add it right here. We would add it back. The next thing we're looking for is a gain or loss on the sale of a fixed asset. In this one, we've got gain on sale of land. Be looking for these, because almost all of our cash flow problems will have at least one of these. Loss on sale of equipment, or gain on sale of land, like this one. Be on the lookout for these. And same thing, we're gonna make it a zero effect in this section. So this is a gain. So up here, net income, we would have added. Down here, we're subtracting. So we're making it like there's zero cash effect. We want to show all of the effects on cash in the next section. We want to get that out of this section. So gain, do the opposite. Notice it's gain or loss. If we had a loss, then we would add it back. So that's it for the leading with, whoops, let me get the whole thing. Leading with net income and adjustments to net income. Those are the kinds of things you're looking for. This example over here is very consistent with what you're going to see. Net income, depreciation, and there's one thing. There's a gain. Okay, now we get to another section. Oh, excuse me. Whew, allergies, excuse me. Now we're looking at changes in current assets and current liabilities. And notice their word, operating. Operating activities, operating assets and liabilities. Operating means current. Current means operating. Which means, oh boy, I'm going to sneeze again, 12 months or less. So like accounts receivable is a classic current asset. It means we expect accounts receivable to convert to cash within 12 months or less. Well, I certainly hope so. I mean, we sent those customers the bill. They were very happy to take product or service from our company, and we're waiting to receive payment from those customers. They're supposed to pay us in a month. We send them a bill. They've got 30 days to pay. You know, chip, chip, chip. Let's go. 30 days. Pay up. So less than a year? Oh my goodness, of course, less than a year. Definitely less than a year. Accounts receivable should be quick. 30 days, 60 days, 90 days. That's getting long. So accounts receivable, current asset. So I'm hesitating here on current. What does current mean? What does operating mean? 12 months or less. What does that mean? So there's, just kind of a side note on all this. There's the cash flow statement itself. Like, can you crunch the numbers out and get the thing to work? There's that part, the number crunching. And then there's the other part, like, what the heck does it mean? Why are we doing this? So ideally you'll have both. So I'm sharing both in the hopes that, yes, you'll be able to do it, but you'll know why and how to do it. It won't strictly be, crunching the numbers. So we're looking at current assets and current liabilities. And we end up with this kind of a section right here. So I want to pause for a minute and look at this section. In the next video, I'm going to do a cash flow statement and talk through it. So bear with me right now because we don't have the whole problem. When you do this kind of work, and by the way, this is probably the hardest part of a statement of cash flows, or what I see students struggle with the most, and what I remember when I was a student thinking, ugh, what? How do I do this? Is this part right here. So I want you to, let's just look at the first one. Increase in accounts receivable. This part over here is what I call the Blues Clues Dora the Explorer part. You're going to go find accounts receivable in the balance sheet, and you're going to go look at the numbers and tell me, or figure out is it increasing or decreasing. That's the Blues Clues part. Yeah, you can compare two numbers and tell which one's bigger. Be careful about the year, because sometimes the columns are goofy. It might not be left right the way you think. So check the column header so you know which year is which year. And then you're going to type, either the word increase or decrease. Right there, they're talking about the account. The account named accounts receivable is increasing. Got it. Now forget about the brackets for a minute. Just look at the number. 220, 326. So you're going to look at the balance sheet for accounts receivable. You're going to have 2 years, like say the end of 2020 and the end of 2019. And you're going to compare those two numbers, and you're going to subtract, and you're going to get this number. So the increase in this account, or the difference from one year to the next, is this number, 22326. That's also a Blues Clues moment. Well, maybe third grade math, right? I don't know. You got to do a subtraction. I always joke about the math. We used to have a math prerequisite on accounting. I mean, like for decades, there was a math prerequisite. Okay, so here you go. You got to subtract. I'm teasing you. So those two, and there's three things to do. Increase. That's a Blues Clues. Which number is bigger? Amount. Blues Clues. Subtract. You're going to find the two numbers and subtract to get the 220, 326. Now the third thing is legit difficult, and that's deciding whether or not this is going to be positive or negative on the cash flow statement. That's where you're going to have to use your mad accounting skills. So you're going to decide, like this one's in parentheses, this is a negative effect on cash. Remember, this whole thing is a statement of cash flows. This is not a balance sheet or no. We're not reporting accounts. No, we're reporting cash flows. So, okay, we know it's an increase in accounts receivable. We know it's 220. Okay, is it a positive or a negative? So what I recommend is that you do this journal entry. Does accounts receivable increase on the debit side or the credit side? We're going to do a little journal entry right here. It's not pretty. Increase accounts receivable. Accounts receivable is an asset. Assets increase on the left. So if we're increasing accounts receivable, it's a debit to accounts receivable. If it was the other way around, if it's a decrease accounts receivable, then we would be crediting accounts receivable. Okay, it can go either way. All right, so this one was increase, so debit accounts receivable. And then you're going to force that against cash, because that's what we want to know. We're doing the cash flow statement. So over time, if the balance in accounts receivable has an increasing effect, that's like a debit effect on cash. That means the effect on cash, did I say that right? Has a debit effect on accounts receivable. Increasing effect on accounts receivable. That means that the effect on cash is a decreasing or a credit effect. That's why this number is in parentheses as a negative amount on the statement of cash flows. It's because of this kind of analysis. Now you can do all that in your head, and some people do, but that's risky, dangerous. I think it's much better to have some little notes to the side in your Excel file, or scribbly notes on a pad of paper in your notebook, where you're kind of tracking how you're getting these numbers. Because I'm just telling you, this is the part that you might struggle with. So how do you get increase, decrease? You're going to look at the two numbers, figure out which one's bigger. How do you calculate these numbers? You're going to look at the two numbers and subtract to find the difference. How do you know if these are positive or negative? Well, that's when you have to analyze the account, think accounting system, which accounts are plus minus, which side. You're going to have to do this kind of analysis. Remember the 6 T's from the beginning? This would be a great time to haul out that 6 T sheet and have it right smack in front of you. So you're just, I mean, you're thinking, yeah, I know, but we're trying something new. We're doing something new right now. We're pushing it to another level. So have that 6 T's reference sheet right out in front of you while you're working on a cash flow statement. So that's the operating section. We've got the income statement stuff up here. We've got the current assets and current liabilities stuff down here. Same thing we did for accounts receivable, you're going to do for every single current asset and current liability account that you can find. I also recommend checking things off on your balance sheet as you go along. Yep, I did that one. Check it off. By the way, this is the hard section, the longest, the most time consuming. We're going to look at the other 2 sections all at once. So we got investing section and financing section. The investing section shows the cash effects on only long-term asset accounts. That's it. So the word investing does not mean I went out and opened a stock trading website account and bought a bunch of stock. No, it's not investing like you might be thinking of the word investing. This is accounting, statement of cash flows, capital I. Investing means long-term assets. So it's a very specific meaning for a specific purpose on this specific financial statement. Here, investing means this company invested in, purchased a bunch of equipment. It's that kind of investing. Like Jackson College invested in a whole big shipment of brand new 2020 Chromebooks so that every student would have a brand new laptop for fall 2020 with COVID-19. That's not happening, by the way, but you get what I'm saying? Investment in long-term asset. Or Jackson College decided to, this actually happened, invest in the Potter Center and do some renovating and updating. You know, like honestly, there were some things that were broken and the carpet was like 30 years old. Investment in long-term asset. And notice this goes both ways. So we got purchase of, sale of, right? And this sale of land had a gain on it. So this sale of land looks kind of innocent, like, woo, just 3 little words and 1 little line, but there's a journal entry that you want to do. You want to look at what was really going on with the sale of land, and was there a gain or a loss, and calculate it all out. Purchase of equipment, probably isn't too bad, probably just a cash effect, but with equipment, since there's depreciation, you always want to double check the accumulated depreciation account and really analyze that account. So when we get to the practice problems in the next video, you're going to see me do all of that analysis. Like, we're going to get deep into accumulated depreciation to really check this number. And we're going to do the journal entry for the sale so we can really check gain or loss to get this number. Before we cruise and leave investing, I want you to notice the plus minus. If we sell land, that means we're getting cash, so it's a positive number. If we purchase equipment, that means we're using cash. This is a negative number. Again, you can do that journal entry I was talking about. I'm not even going to do that right now because there's more going on here. Investing. That's it. There's not going to be very much here. Like this one's got 2 items. You might have 1, 2, 3, 4 items. You're not going to have a lot. Add them up, get your subtotal. All right, take a look at financing. The financing section includes all cash effects related to long-term liabilities and all of the equity accounts. Okay, long-term liabilities like notes payable, bonds payable, mortgage payable. Long-term. Long-term means, what do you say? Long-term means more than 12 months. Current means less than 12 months. So if we got notes payable due in 9 months, that's current liability. If we got notes payable due in 9 years, that's a long-term liability. So these first 2 are long-term liabilities. Proceeds from, that means we borrowed money. That means this is a positive. Payment on, that means we used cash. And notice these words down. I mean, the whole thing, you know, there's language to this. Definitely use an example. You're going to have a few from this video series. Of course, you know, there's all kinds of things online. Use your textbook. There's just so many examples. Use an example that will help you with this word choice language kind of thing. Proceeds from, payment toward. Let's look at the next two for equity. Payment of dividends. Payment, paying cash, so that's negative. Issuing more equity. Issuing preferred stock, like debit cash, credit preferred stock. Increase cash. That seems kind of low for preferred stock, but right? That's how they did it in this problem. So you're going to analyze those kinds of accounts and put the effects here, add them up. Hey, one thing about the word financing. The word financing is the word financing here. There's no special definition. Financing means raise capital, raise funds. So when a business has long-term borrowing, that means they're getting cash. One way or the other, it means they're going to get cash for the business. When the business issues equity, like common stock, preferred stock, owner investment, that's increasing equity so that the business increases cash. And then yes, there's this offset, like cash dividends or owner withdrawals. Yeah, you're going to pay your owners a little bit, probably. So financing, raising cash for the business through long-term debt and equity. That's it for the three sections, and you're going to summarize and add up. Let me scroll up just a little bit. So here's the first section, second, third. You're going to do an auto sum right here. Whoosh, add them up. Check beginning and ending balance on your balance sheet and make sure this thing works out. Check your math. This is a self-checking financial statement like a balance sheet. You're going to know if this works out or not. I'd like to go back through the gold. We got some income statement things here. And then the rest of it, let's see if I can get it all on the screen. Good. Assets. Well, here's current assets and here's long-term assets. Here's current liabilities and here's long-term liabilities. So that's all the assets and all the liabilities and equity. So everything from top to bottom on the balance sheet is analyzed account by account for what is the effect on cash, and then reported in the right section and documented here in the statement of cash flows. That's what this is all about. So, I'm going to post this file for you. Keep in touch. I would love to hear, make sure it's clean. I know there's an F here, so keep it clean, keep it classy. I'd love to hear some, what are they called, mnemonics, some memory devices for OIF. Something better than Ohio is fun, and forgive me if you're from Ohio. Hey, thanks for being with us today. That's the introduction on the statement of cash flows.